Topic introduces counterparty credit risk, CCR, as the risk that a counterparty in a financial transaction may default before the final settlement of all contractual obligations. Unlike traditional lending risk, counterparty risk is bilateral because the exposure changes over time according to market movements and contract valuations. CCR is especially significant in derivatives, repurchase agreements, securities lending, and other over-the-counter financial transactions. Financial institutions face potential replacement costs if counterparties default while contracts hold positive market values. The global financial crisis highlighted the systemic importance of counterparty credit risk because the failure of major institutions demonstrated how interconnected financial obligations can rapidly spread losses across markets and institutions. The topic further explains the primary components used to measure counterparty credit risk exposures. Current exposure represents the replacement cost of a contract if default occurs immediately, while potential future exposure estimates the maximum likely exposure over a future horizon under changing market conditions. Exposure at default combines these concepts to estimate total expected exposure at the time of counterparty failure. Because derivative values fluctuate continuously with changes in interest rates, exchange rates, equity prices, and commodity prices, counterparty exposures are highly dynamic. Financial institutions therefore rely on simulation models, stress testing, and statistical analysis to estimate exposure distributions and manage evolving counterparty risks effectively. A key topic is the role of collateralization, netting agreements, and central clearing in mitigating counterparty credit risk. Collateral agreements require counterparties to pledge assets or cash to reduce unsecured exposure and absorb potential losses. Netting arrangements allow institutions to offset positive and negative positions under legally enforceable contracts, significantly reducing total exposure. Central counterparties, CCPs, further reduce bilateral counterparty risk by becoming intermediaries between trading parties and enforcing standardized margining practices. These mechanisms collectively improve market stability and lower systemic vulnerabilities. However, institutions must still manage operational risk, liquidity risk, and concentration risk associated with collateral management and centralized clearing systems. Topic also focuses on stress testing as a critical tool for evaluating the resilience of financial institutions under adverse economic and market conditions. Stress testing examines how portfolios, exposures, capital positions, and liquidity levels would perform during severe but plausible scenarios. Unlike standard statistical models based on historical relationships, stress tests evaluate extreme conditions such as financial crises, market crashes, sovereign defaults, or sudden increases in volatility. Financial institutions use stress testing to identify vulnerabilities, estimate potential losses, and assess whether sufficient capital and liquidity buffers are available. Regulators also require stress testing programs to strengthen financial stability and improve risk governance practices across the banking sector. The topic also discusses different stress testing methodologies and their applications in counterparty risk management. Sensitivity analysis measures the effect of isolated risk factor changes, while scenario analysis evaluates the combined impact of multiple adverse market events occurring simultaneously. Reverse stress testing begins with a failure outcome and works backward to identify conditions capable of producing catastrophic losses. Institutions increasingly integrate macroeconomic variables, market correlations, and liquidity pressures into stress testing frameworks to capture systemic risk more effectively. Stress tests are particularly important for identifying wrong-way risk, concentration risk, and interconnected exposures that may not be fully reflected in normal risk models or historical data patterns. Finally, topics emphasize the importance of integrating counterparty credit risk management and stress testing into comprehensive risk governance frameworks. Modern financial systems are highly interconnected, meaning failures of major counterparties can trigger widespread market disruptions and systemic instability. Effective counterparty risk management therefore requires continuous exposure monitoring, collateral management, robust modeling techniques, and legally enforceable risk mitigation arrangements. Stress testing complements these practices by evaluating institutional resilience under extreme but plausible conditions. Together, these frameworks improve capital planning, enhance transparency, and strengthen financial stability. By combining quantitative analysis, governance oversight, and scenario-based risk assessment, institutions can better manage evolving counterparty exposures and systemic financial risks.